expecting this to persist for some time. They're gonna run down their balance sheet. They're especially going to make sure to run down their mortgage book, because there are decision makers that perceive that their mortgage book is much too large. The other side of this equation, which you've commented on quite extensively, is the Treasury, right? So to what extent is the Treasury issuing bills, notes, and bonds, and in what duration and at what time, right, is going to impact the liquidity conditions? So maybe walk us through that side of the equation.
Yeah, sure. So the way I like to think about it is in liquidity terms. The Treasury has a budget to finance. It has bonds that are maturing that need to be, some of which the Fed owns, that need to be refinanced. And so it needs to sell securities. It's still running a budget deficit. We'll come back to that in a second, because that, I think, is very important. And so they need to issue. And if they had to issue $1 trillion of bills, they would, that would change the portfolio a lot. And there's some guidelines and things that prevent them from issuing only bills. But if they were to do such a thing, that would have a minimal impact on, possibly even no impact on financial assets. On the other hand, if they issued $1 trillion of 30-year bonds, the 30-year bond would crash. They issue a couple $100 billion a year, so of 30 years. So if they were to weigh on the curve all that, they would crash the 30-year, which would crash corporates, which would crash equities. And so those impacts are very important. So what are they doing? So you have to ask yourself, okay, so what they might do is the Treasury has a different role than the Fed does. The Fed is trying to fight inflation. The administration is trying to fight inflation. They're using gimmicky things like petroleum drops and
SPR.
Of the SPR, yep, and also scary things like politically potentially, very appropriate, but from an inflation standpoint, misguided things like globally this is happening, handing people who are buying gas credits, which saves them the money. And it's a wealth transfer. I'm not making any judgment on that. But it doesn't reduce, in fact, it increases the demand for the commodity that's already in short supply. So, administrations are going to do what they're going to do. Some are going to be gimmicky, some aren't. In Janet's case, she has a real legitimate lever. And if she believes, which she's given no indication that she does believe this, but if she believes that by issuing long-dated bonds, the wealth effect will fight inflation, and that's attractive to her, she may go in that direction. Right. On the other hand, Janet also has I think it's politically difficult to crash a stock market and get reelected. And so the Fed doesn't have those concerns. It just needs financial stability, and another 20% on the stock market doesn't matter to them, but it probably matters to the Democrats' chances. I think they've probably written off 2022, but for even 2024, they don't want a Democratic administration to have a stock market crash. That's just very hard to recover from. So she has both sides to concern herself with. So then let's talk about briefly what she has done. And the answer to that is she has used her levers intelligently. Firstly, she has while the Fed was still doing QE, she issued a lot of coupon bonds and a lot of bills in Q1. And she completely funded what's called the Treasury General account, which is her essentially the government's checking account where they spend the money. They collect taxes in it, and they use that account for spending. And she funded that from what had, for all intents and purposes, was zero because, at the end of Q4, because the debt ceiling was in place and she couldn't issue more debt. She really pressed out a lot of money and funded that, and it's almost $1 trillion right now. In I guess February, late January, the quarterly refunding announcement came out, and she had reduced coupons significantly. And that's an important thing. It said, we get QTs coming. We funded our checking account. We're going to lay off the bond market a little bit. But it was still, so coupons have come down. Coupon issuance, long-dated Treasury issuance has come down. But then this very unusual thing has started to happen. And that is when you have high nominal GDP, and nominal GDP is not the reported number, it's the sum of the reported number plus inflation. So last quarter, we had a negative 1.4% annualized real GDP, but we had an 8% annualized inflation rate. And so the nominal GDP was, 6.5-ish. And taxes are paid in nominal dollars. And we really grew, not in a nominal sense, we really grew last quarter. And so our tax revenues have come in quite a bit, gone up quite a bit, while our budget hasn't changed. So what that means is our deficit has come down, and when our deficit comes down, our need to issue comes down. And so it turns out that, and I put a lot of attention on this last week, May 2nd was the first date that it happened, but the new quarterly refunding announcement came out, and it showed that even though they had planned on borrowing $66 billion in Q2, which again was a very, very small number, they reduced that to negative $26 billion. So in fact, this quarter, our net issuance is going to be negative. That means we're going to actually retire some of the country's indebtedness, which means supply is lower. And so I looked at that when it came out at 3:00 on Monday before the Fed, and got very bullish very quick. I was flat going in and really expected that to have a major impact. 2 days later, they announced the details. And interestingly, they reduced coupons, but because they still had so little to finance, they really cut bills issuance. And so bills issuance is now, substantially negative, and coupon issuance was higher than I expected, even though the total issuance was much lower than anyone had expected 2 days earlier. Then the market started cratering soon after that weird spike on Powell saying 75 was off the table, that reversed the next day, because in my view, there's once again a reason to front run quantitative tightening after that quarterly refunding announcement. So I think that was a very subtle issue, but if you caught that, you could have traded a very wide range effectively.